Lately, the question of inflation is on everyone's mind because commodity prices are rising and the US long-term interest rates are rising, which means that the markets are asking for a discount on US bonds because they are afraid of the future. So everyone is making their own predictions. I have been wondering about this damn inflation since about April 2020. The question is whether we will go into deflation or inflation. Contrary to what one might think, the ridge where everyone can tip over is quite thin because in both cases, these are two different ways of seeing our impoverishment. I therefore suggest that we reflect together to better understand what we can make the wind change and how to adapt to our savings in this situation. Come on, let's go. What is the message that is currently circulating in favor of an inflationary scenario? As a reminder, inflation occurs when the quantity of money available and/or its speed of circulation increases relative to the quantity of goods and services available. So, for inflation to occur, either money must be injected into the economy or this money must circulate faster, or the number of available goods must decrease for the same quantity of money and the same speed of circulation. This is the famous Fisher equation, MV equals PQ. As a reminder, the money supply of a country is equal to the monetary base multiplied by its velocity of circulation. If the money base of a country is, say, 1,000 $1 bills, and these bills have changed hands 3 times in a year, then the money supply is $3,000. This directly affects GDP. Now, if the people of this tiny, fictitious country get scared about the future, they will slow down their consumption, and our 1,000 bills will still be there, but they will change hands less quickly. So, if our bills change hands 1.5 times instead of 3, then the money supply will be $1,500, and you will get a big economic crisis at the same time. What I'm telling you about my little village is exactly what happens in real life. The monetary base is still called a monetary base, and we can see that it is constantly increasing because the FED is printing like crazy. It's the same thing in Europe. It went from $1 trillion to $5 trillion between 2008 and 2020. You will notice that the curve resembles the evolution of the FED's balance sheet. This is not a coincidence at all, since the monetary base of a country is controlled by the central bank of the same country. Besides, the banknotes in your pocket are money issued by the central bank, so your banknotes are the monetary base. We also call the monetary base M0. Then, for the money supply, it's a little more complicated because there are several ways to count it, but to make it simple, tell yourself that we call it M3. M3 is equal to M0 multiplied by the number of times the monetary base has changed hands. And here, when we look at M3, we see that it has gone from about 8 trillion to about 20 trillion, so a multiplication of 2.5. This is twice as little as the evolution of the monetary base, so that means that between 2008 and 2020, money was circulating less and less. And this can be seen perfectly if we look at the velocity of money. It has collapsed from 2 to 1. In other words, money changes hands half as much in 2020 as it did in 2008. Today, money makes 1 turn instead of 2. As I told you at the beginning, when the velocity of money slows down, the economic crisis is just around the corner because it means that people exchange less and therefore the GDP goes down. That's why Western central banks are printing like crazy to keep the M3 money supply in circulation. The decrease in velocity is a deflationary factor, and central banks have been fighting against this for more than 10 years by injecting money. We can see the drug effect of monetary injections. The slowdown in velocity is a deep symptom of an economy that is suffering because the economic fabric is atrophying. Injecting money does not solve the problem, but it masks it by keeping alive those that should disappear. So, we need more and more injections for less and less efficiency. That's why central banks' liquidity injections look like exponentials as time goes by. That's not good at all. We can see that there is a struggle between inflation and deflation that has been going on for a long time. Basically, the economy wants to purge itself to put prices back in the right place. I think about the exchange rate with China, but also about the interest rates which are forced to zero, but our government don't want to do it, because to put the prices back to the right place means a huge economic crisis which will not fail to shake the power in place. Moreover, we know when we enter this kind of crisis, but we don't know when and in what state we come out of it. If we take the example of the USSR, which was in a situation where many prices were wrong when it went bankrupt in 1989, it results in 30 years of misery. Russia is just beginning to emerge from this period. So I can fully understand why our leaders are not in a hurry to experience this kind of event. However, time has passed and the crisis of the anti-COVID measures has put a serious acceleration on this process. Today, we find ourselves in a delicate situation where the balance between inflation and deflation is increasingly difficult to maintain. The USA has chosen its side, since Jay Powell and Biden announced in an article in the New York Times on February 15, 2021, that inflation was much less evil than deflation. In conclusion, they are ready to print whatever it takes to keep the deflation monster in the closet, even if it means inflation. There is another parameter to take into account. Given the weight of the US debt, the US central banks cannot raise short-term interest rates. The principle is simple. In order to pay the debt, or at least not go bankrupt, it is necessary to pay in monkey money thanks to high inflation. The counterpart will be the ruin of the savers since the savings are no longer remunerated. All the subtlety of this strategy to avoid paying off the debts is to avoid the monster of hyperinflation. Here's an example of how hyperinflation can settle your debts but also destroy your economy. Let's say that the commodity prices go up, as they are today, for a whole bunch of commodities like wheat, copper, or oil. Logically, the US or European producers would raise their prices since they are globally importers of these commodities. The problem is that your economy is depressed and your population has no money to pay more. So either they consume less and you have recessionary deflation, which is a very painful but necessary scenario, or you print money to give to people who can maintain their consumption. In this case, there is no inflation because you are not in an economic boom, but you escape deflation. You have gained a day. The problem is that the more dollars you inject directly into the economy, the more dollars there are out there. So after a while, the commodity exporting country starts to understand that the dollar is not what it used to be, because everyone has plenty of them and commodity prices continue to rise, but in dollars and euro only. In other words, it is the exchange rate that breaks. Why the exchange rate? Because it is a price that cannot be manipulated indefinitely, even when you are called the United States of America. Especially since we should not forget that China has embarked on a path of long-term stability for the yuan. For the first time in a long time, there is the beginning of an alternative to the dollar for savers who want to return on their savings. And it is precisely in this configuration that we are on a crest line. Either the currency breaks down because too much money is being printed and inflation goes into overdrive, or the economic system breaks down first and deflation sets in. How do we get out of it, you may ask? Well, like the USSR in the 90s, it is necessary to purge the false prices and to put the lifestyles in front of the income. The most complicated thing in these times is the political stability. In the USSR, it cannot be said that it was painless if we admit that it is over today. But the most important question is, what can we do as individuals regarding this subject I deal with on this channel, namely the subject of savings. A portfolio is built around a stabilizing pocket and a growth pocket. As far as the growth pocket is concerned, equities remain a good option, as long as you choose leaders in their highly internationalized sector in order to bet on large companies that have the means to adapt to change. Then, for the stabilizing pocket, the combination of gold and Chinese bonds seems to me the most promising. On that note, I'll see you soon for new videos. Ciao!
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.